My name is Raghavendra Rau, right? I'm the Sir Evelyn the Rothschild Professor of Finance at the University of Cambridge. I'm also the Gresham Professor of Business here at Gresham College. A lot of people know this already because I see some familiar faces around the room. This is the second in my series of lectures this year, which is on the big ideas of finance. Right? So what I'm going to talk about today is the second of the big ideas. And this is the first idea we're going to talk about that actually won a Nobel Prize in economics. So there will be some maths involved here, but I'll try to make it as intuitive as I can, right? Especially late evening, you don't want to get hit with the whole blizzard of equations. So let's try to make it intuitive. So all these ideas are actually in my book, which is Short Introduction to Corporate Finance. 6 chapters, tells you 1 chapter per idea. So if you want to go back, read all about it, that's it. It's also in Chinese, if you prefer to read it in Chinese. Okay, so what are these 6 basic ideas? The first idea is the idea I talked about last time, the concept of net present value. Right? But net present value, as we'll see today, requires a discount rate, requires an interest rate. So that is a topic of today's lecture, is portfolio theory and the capital asset pricing model. And 2 people, Harry Markowitz and William Sharpe, got a Nobel Prize for this in 1990. The other 4 ideas, capital structure theory, also won a Nobel Prize for Modigliani and Miller in separate years. Option pricing got a Nobel Prize for Scholes and Merton in 1997. Asymmetric information, 3 people, Akerlof, Spence, and Stiglitz, won a Nobel Prize in 2001. And finally, the last topic, which will be in June next year, is a bit confusing because several people won the Nobel Prize in this area, including people who said completely the opposite things but won the Nobel Prize in the same year. That's Farmer and Schiller in particular. But we'll come back to that in June next year. So what is finance all about? Right? At its core, finance is very simple. It's basically a set of promises. Basically, somebody is saying, you know what? Give me some money now, and in return, I'll give you some fantastically large amount of money at some point in the future. The question which we have to answer as a finance person is, what are these promises worth? Like, how much would you pay somebody who's promising to pay you a huge amount of money in the future? And last time we saw that the answer to this question was about net present value. That means we have to compute the present value of those future cash flows to today and compare it with the amount we're supposed to spend today. So if somebody says, I'll give you $500 5 years from now, the question is, what's the value today? How much are we willing to pay for that $500 worth today? And unfortunately, to get that, we need one equation, and that is the basic equation in finance, that concept of net present value. So what is that equation? The equation is straightforward. It looks complicated, but all it's saying is the present value of a bunch of cash flows, denoted by C1, C2, and C3, and so on, is just divided by 1 plus r squared, 1 plus r to the power 3. We discussed that in the NPV lecture, but the idea is each of those cash flows in the future is worth C divided by 1 plus r today. Okay? The problem, which we didn't answer there, is that where does that interest rate come from, right? We have everything we need, except we don't know what that discount rate, what's the appropriate R in that equation. We can figure out what the cash flows are. For example, if you're valuing a company, the cash flows are the earnings. If you're valuing a stock, the cash flows are the dividends. If you're valuing a bond, you're getting interest payments and the final face value. So those are the cash flows. You know what the cash flows are, but how do you figure out the interest rate? That's the subject of today's lecture. Okay, so how do we think about this? So somebody comes to you and says, I want you to invest in my company. Right? What you're thinking about is, okay, if I don't invest in the company, what else can I do with my money? Right? What you want is to find out what is the opportunity cost of investing in this particular asset. Because the moment you invest in this guy's company, the money's locked up. You can't take it out and use it for something else. You can't spend it on a good restaurant. You can't spend it on a movie. Right? It's locked up in this guy's investment. So the question is, what is my next best opportunity? If I don't invest in this company, where do I put my money? But of course, that opportunity has to be equivalent. right? You can't say, okay, invest in my high-tech company. The alternative is put my money in Barclays, right? The interest rate at Barclays is pretty low, and so it's definitely not comparable to anything which you might get from investing, for example, in OpenAI. Right? So that means the opportunity should be equivalent in terms of risk to what the actual asset is you're being asked to invest in. Okay? But then the question becomes, what is risk? Right? How do we measure risk? So does it depend on how risk-averse you are? Right? Maybe someone who's risk-averse says, you know what, this is extremely risky. I don't want to invest in this. So I'm not willing to pay very much for this very risky investment. Or does it, if you hate risk, for example, will you pay less? That means, in other words, will your discount rate be higher than someone who doesn't care about risk? So basically, someone who doesn't care about risk will say, I'm willing to pay more for this highly risky investment. Someone who hates risk says, I'm not willing to pay very much for this investment. So how do you decide what is the right level of the opportunity cost for investing in a particular asset? All right, so let's ask ourselves, first question is, what does history tell us about opportunities? So this graph here is taken from Ibbotson and Sinkerfeld. Basically, they've been calculating every year what happens if you invest money over time. And so what you have here, you go back to 1926 and invest $1 in small cap stocks, basically small companies. By the year 2022, end of last year, you'd end up with $49,000 today. $1 in 1926, you'd end up with $49,000 today. However, if you invest in large cap stocks, big companies, companies like GM, Tesco, large companies, you'd end up only with $11,535. If you're invested in long-term government bonds issued by the UK government, issued by the US government, whatever, you'd end up with $130. If you had invested in short-term bonds, bonds of less than 1 year, $1 in 1926 would end up with $22 today. Right? And finally, inflation. What was worth $1 in 1926 is worth $16.58 today. Okay? So taking this graph, you've all seen this graph. Now imagine you've invented a time machine. You can go back to 1926, and you have the opportunity to talk to your granddad or your great-granddad, depending on how old you are. And so your granddad says, you go to your granddad, so introduce yourself, and say, look, I'd like you to take $1 and put it into something. What is that something you will put it into? Let's go and ask that question. So basically, scan that code in, and you can vote for any of those opportunities. Which one would you pick? So small stocks give you $49,052, $1. Large cap, $11,535. Long-term government bonds, $131. US Treasury bills, $22. What would you invest in? Okay? You know this information, by the way. You know all this, right? So you've gone back in time. You've gone into the past, knowing what you already know. Somebody here is super risk averse. I mean, given that they already know this, they're still choosing to invest in Treasury bills. I would really like to meet that person after this lecture. 2 people. Maybe they're online. This is also open to anyone online as well. Right. Okay. So it looks like majority of people would say, yeah, makes sense, right? So invest in small stocks. $1 in 1926 ends up with $49,052 today. It's almost a no-brainer, right? Knowing what you know. Of course, the problem is, keep that open, by the way. I'll keep asking more questions. The problem is, you persuaded your granddad to invest in small stocks, and then 1 year later, it's 1926, right? And Great Depression his $1 has lost 92% of its value in 1 year. What's your granddad going to say? He's going to say, my good-for-nothing grandkid came back from the future, claims he knows everything, and I've lost most of my money. What a git, right? I wish the kid had never been born. So you have to have nerves of steel to say, no, hold on. Keep investing. Don't sell at that point. And eventually it'll get to 49,000. But he's like, I have lost 92% of my money in 1 year. He's not going to be very happy. Okay? So obviously then the answer depends on how long your horizon is. Okay? So this graph here shows you what happens if you invest in different types of assets. If you invest for 1 year, what you see is there are lots of, so the red lines there are for a portfolio of small stocks. The blue lines, the green line there, the blue line is the S&P 500. That is a portfolio of large stocks. The corporate bonds are the yellow line, and the green line at the bottom is treasury bills. Right? Notice that treasury bills, you almost never lose any money, right? It's flat. However, if you invest in small stocks for 1 year, there's a possibility of making a lot of money. Look at 1927, or 1929, sorry. But there's also a possibility of losing a lot of money, right? So you can either make a lot of money or lose a lot of money. So over a 1 year horizon, small stocks are not better. Okay? Large stocks aren't better either. You can make or lose a lot of money. What about 5 years? Well, there are still periods of time when you hold small stocks for a long period of time that you see that it's better off with treasury bills. You have to go to 10 years before the numbers start moving up. So over here, what you see is there are still periods of time when you're better off with treasury bills. Right? Even over a 10-year horizon, stocks are not always better. It's only when you go to 20 years that the green line is perpetually below the red and the blue line. However, it's still, there are points in time when you have been better off in bonds than in stocks. So clearly, the only way you can get that answer, invest in small stocks, is if you know the future for 120 years. Right? If you don't, you're never going to know whether you're going to make money or not. Okay? In fact, we don't even know what the future is going to be in the next 5 years. So if you look at if the future is going to be like the past, well, 1987, we had a high in October 1987 where the volatility jumped by 150% on one day, the 19th of October, 1987. And similarly, different crises, the global financial crisis, the Greek crisis, the Euro crisis, the COVID-19 oil shock, all have these spikes in risk. So how do we predict the future? We don't even know 1 year ahead what's going to hit us. Okay? In fact, that particular day, October 19th, 1987, the entire Dow fell by 23% in 1 day. So why did that happen? What do you think? What do you think? That is actually a brilliant answer. The answer is nobody has a clue. Right? 45 years later, we still don't know why it happened. Could it happen again tomorrow? Maybe. We don't know. Nobody knows why it happened. Okay? Biggest loss in history. Okay, the other ones are more explainable. 2020, March, COVID. October, 1929, Great Depression. Those are sort of explainable, but the biggest drop ever, we just still don't know why it happened. Okay? Tough to figure out what risk is.
Well, I saw in a documentary that they say that it was the dawn of algorithmic trading.
That is, absolutely. There are lots of explanations, but there's no convincing explanation. Nobody has said, this is what triggered it. What happened? What happened on that day that started it falling? We don't know. We may think something made it worse, portfolio insurance, other things like that, but nobody knows why it started. Okay, fine. Good answer. Okay, so what can we tell from the past? Not very much, right? It's not a very good guide to predicting the future, but what we can tell is, if you look at the historical returns from 1926 to 2017, these are the frequency with which we see different annual returns. So the green one at the top is treasury bills. So you can notice that with treasury bills, what happens is you don't lose much, you don't lose any money, but you make a little bit of money, right? With AAA corporate bonds, you see there's a slightly wider dispersion over here, right? There's some possibility you lose money, but not much money. Some possibility you make money, but again, not much money. Portfolio of large stocks, well, some possibility you lose a lot of money, some possibility you make money, and of course, with small stocks, there's a possibility you lose a lot of money, but there's also a possibility you make a lot of money. Right? So one way to think about risk may be you're looking at the width of that distribution. How dispersed are those returns over time? Are you going to make money? Are you going to lose money? If there's a wide dispersion, maybe this is riskier. Okay? Fine. Can we quantify this? Well, let's take treasury bills. Right? We call treasury bills risk-free. We call government bonds risk-free. So taking government bonds, the question is, if I want to buy a corporate bond, which has some possibility of going bankrupt, the company going bankrupt and not paying back its money, people say, okay, you want me to invest in that? I need a little more money than the amount I spend in treasury bills. How much more money? About 2.9% more. That's called the risk premium. Right? It's the additional return which you ask for in order to invest in small stocks or S&P 500 or corporate bonds and so on. So what you see over here is what we call the risk premium. How much additional return do I want for investing in something? Okay? Now, one question at this stage is, what is that risk-free rate? That's crucial to our analysis, right? So let me ask you at this stage to go back and ask the question, if I have these three government bonds, which of these is the least risky? That will be number one. Which one is the most risky? That will be number three. So go ahead and use your phones to move it around. What do you think is the least risky and what is the most risky? So you can slide it up and down. Excellent. What this is basically saying, German government bond, least risky, Indian somewhere in the middle, and Argentinian government bond, definitely the most risky. Right? This is common sense. Right? This is what most people would say is indeed correct. Unfortunately, according to finance, this is wrong. Right? Why? Well, what does risk-free mean? Risk-free means what's the likelihood you're going to get back your money? So let's go to the bond here, which we say is the second riskiest bond, the Indian government bond. Suppose you go to the Indian government and you say, you've issued a bond, time to pay up, I want my money. But the Indian government has no money. What can they do? They can actually just print the money. It's just a piece of paper, right? Print the money, give it to you. If they print too much paper, it's inflation. And that's why no one trusts the Argentinian government, because they started issuing pesos, but every time a peso bond was issued, they would always print more money, which means hyperinflation or inflation or whatever. So, but as long as the government is responsible, it's completely risk-free, because you will always get your money back. You will always get a piece of paper back saying, this is the debt of the government. Okay? The German government, interestingly, bonds are issued in euros. However, euros are not under direct control of the German government. It's European Central Bank. And so the chance of this is almost close to zero, but there's a tiny, tiny, tiny chance that the German government says, we want to issue bonds in euros, the ECB will say no. Very, very small chance. But because of that very, very small chance, the safest bond is indeed your Indian government bond. The second safest is your German government bond. You may say the chance of that is zero. It isn't. It's slight possibility. Right? And that's why we say it's not completely risk-free. Okay? So now, risk-free is a very simple definition. Do you get your money back? And the answer is yes. If the government issues bonds in its own currency, you will get your money back, because the government will just print the money if it needs to. Okay? So that's the definition of a risk-free rate, which essentially means there is only one risk-free rate around the world. You can think of American risk-free rate, you can think of English risk-free rate, doesn't matter, because one of the principles of finance is if there were two different risk-free rates, you would borrow at a cheaper amount, you would sell at the more expensive amount, and you could make money. And as we'll see, as we saw last time, there's no such thing as a free lunch in finance. This is the basis of something called the carry trade. We'll talk about that in the last lecture. But even the carry trade carries risks. It's not risk-free. It's not arbitrage. But at the moment, let's leave that out. We're going to assume risk-free rate is a bond issued by the government in its own currency. Okay. So if you plot these returns, these ones we just saw, against risk, so you've got the volatility here, you've got the return here. And what we see is a beautiful straight line. And you say, oh, wow, this is pretty cool. I've solved the problem. Because what this is telling you is high volatility, the higher the width of that distribution, the higher the return. And I've got a line. The line explains it. So if you tell me what the volatility is, I can put it on the line, and I can tell you what the return should be. And that's what I'm looking for, remember. The return is the discount rate in that equation, which I'm trying to find out, the NPV equation. The R is the denominator at the bottom. And this graph seems to tell me everything. Well, no. The problem is it works for portfolios, but it doesn't work for individual securities. So if you look at IBM, Tesla, General Motors, Tesco, doesn't matter. They're scattered all over the place. There is no relationship between risk and return for all the individual securities. But that's what you're being asked to invest in. You're not being asked to invest in a portfolio. You're saying, if I invest in something, one of those is what you're doing. Okay? This is the problem we have. It doesn't work for individual stocks. All right. So what we have established so far is history is useless. Right? We've also established that it doesn't, for outside anything individual securities, it doesn't tell us very much. So we need to step back, right? What does theory say? What is risk according to theory? The answer is we don't know. Right? We really, as finance people, we don't know very much. Right? But honestly, the good news is we get paid a lot of money for not knowing anything, which is a good thing. But anyway, the point of this is finance people think about risk in one particular context. We focus on something called the variance and the standard deviation. Why do we focus on that? To understand that, the variance is just the width of a distribution, how wide that distribution is. That's the average number. So how much do you see numbers on the left and how much you see numbers on the right? That's the width of the distribution. So you want a quantitative measure trying to find that width. Okay. Fine. Why do we focus on variance? The good news is, if stocks are drawn according to a normal distribution, we only need two things to know everything about that distribution. We need to know the number in the middle, where the peak of that distribution is, and the standard deviation, how wide that deviation can be. Now, what's interesting about this? What's interesting about this is you can appear incredibly smart as a finance person, right? So let's assume, and normal distributions are everywhere, right? If you take all the heights of people in this room, it'll be a normal distribution. Most people will be in the middle, some people will be short, some people will be tall. Weights of people, normal distribution. IQs of people, normal distribution. Everything in nature is a normal distribution. So we assume that stocks follow a normal distribution. And the advantage now is, let's say your client comes to you and says, I'd like to invest in something. And you say, I think I should invest in large company stocks. So, really? How much money can I make? So, okay, I think you're going to make about 13%. Why? Because history tells you that's a normal distribution. So, okay, that's fine. But I'm also worried about losing my money. What's the chance I'm going to lose my money? Again, normal distribution tells you there's a 68% chance that a return drawn from a normal distribution will be within one standard deviation of the mean. So basically you say, you know what? You're not going to lose. There's a 2/3 chance. You're not going to lose more than 7%, but you're not going to make more than 33%. I said, well, that still leaves 1/3. What about the other 1/3? No worries. There's a 99% chance you won't lose more than half your money, and a 99% chance you won't make more than 75%. That makes you sound super smart. Right? I'm giving you numbers. It's a 99% chance. People are like, wow, this guy is an amazing financial advisor. But all you're doing is pulling the numbers out of a normal distribution. So are stocks distributed normally? Answer is not quite, right? What happens is bad stuff and good stuff happens a little more than predicted by the normal distribution. Why? Because portfolio theory assumes that everybody is acting by themselves. All of us are making individual decisions. But reality, we don't. We look at each other. So if everybody's panicking, what happens to us? We panic too. So bad stuff happens a little more frequently than predicted. Good stuff, it's fear of missing out. They're like, oh my God, everybody else is making money. How am I not making money? So we buy more shares than we can. So, but for most of us, it sort of looks like a normal distribution. So I'm going to pretend it's a normal distribution. Okay? All right. So let's restate this problem now. The problem we have is we want the opportunity cost if you don't invest in a particular investment. Okay? Fine. That is the return of the next best opportunity. That's the return we need for the NPV formula we discussed in the last lecture. Okay? But every individual security will have its own expected return and its own standard deviation. We'll see that in a minute. And in addition, every investor has his or her own risk preferences. So how do we come up with one number that everybody agrees is the only interest rate for that particular security? This was the problem that Markowitz and Sharpe were faced with. Nobody had solved this. And their solution to this question got them both a Nobel Prize. Okay? So let's see how that works. Let's start with the intuition. You have three possibilities. Right? You can invest in an ice cream company. In sunny weather, everybody eats ice cream. So your $1,000 investment becomes $1,200. That is a 20% return. In rainy weather, nobody eats ice cream. So the $100,000 investment becomes $920. You have lost 8% of your money. Okay? Umbrella company, the other way around. Sunny weather, nobody buys umbrellas. Rainy weather, everybody buys umbrellas. The numbers are flipped. Okay? You make 20% or you lose 8%. Okay? The probabilities of sunny and rainy weather are 50-50. This slide was not written in England, right? Obviously, because you'd say 80-20, but no, that's fine. So the expected profit, sometimes you're going to make 1,200, sometimes you're going to make 920. The average of the two is 1,060. That's the $60 profit you make. Okay? You've invested 1,000, that's 6% expected return. And the standard deviation is sometimes you make $140 more than 1,060, that's at 1,200. Sometimes you make $140 less than 1,060, that's a 920. That's 14% here and there. Right. Fine. Umbrella company, same thing, opposite directions. T-bills don't depend on the weather. So regardless of whether it's sunny or rainy weather, you get back 1,030. That's a 3% return and no standard deviation. You're getting the same amount every period. Okay? So if you have a choice between these three things, right, what would you choose to invest in? The ice cream company, the umbrella company, or treasury bonds? To put that into perspective, let me show you again what I'm actually looking for, right? So you have a treasury bill, 0 risk, and 3% return. Ice cream and umbrella, 14% standard deviation, and 6% return. Well, that's what you are looking at. Excellent, right? Key part, what you can see here is there's no pattern. You can see that people are they like ice creams a little more than umbrellas, but other than that, there's nothing wrong with these answers, right? I mean, all of the answers are totally fine, right? So you can't say that anybody's wrong on this basis. You like umbrellas, fine, that's you over there. You like ice cream, fine, that's you over here. You like to be safe, that's you over here. No big deal, okay? Nothing wrong. Okay, now let's change the question a little bit. I'm going to add a portfolio. half my money in the ice cream company and half the money in the umbrella company. So in rainy weather, in sunny weather, the ice cream company makes money. So my $500 investment becomes $600. But the umbrella company loses money. The $500 investment becomes $460. Add the two together, 1060. Okay? Same thing over here. Opposite, right? The umbrella ice cream company is making money, the umbrella company is losing money. And so you make $60 on average, which is a 6% return, but with no standard deviation. Again, you're basically saying, I'm going to get 1060 because what you make in one company, you lose in the other. They cancel each other out. Put it together, what you have is a portfolio investment which has the same returns as the T-bill, but higher returns. Right? Same risk as the T-bill, but higher return. It has a lower risk than the ice cream umbrella company and the same returns. So the question now is, if you have a choice between these four investments, which one do you choose to invest in? There's somebody who's still obsessed with ice cream. Right? And that's what I mean by the intuition behind portfolio theory. What you have over here is, individually, when you're given all these things, it's very difficult to choose. But once you start combining things into a portfolio, some of that risk disappears. And so there is an overwhelming consensus that you should invest in the portfolio company. It is giving you the highest return per unit of risk. Right? That's the idea. That's what we're going for. Okay? But to get there, we need a couple of additional steps. Let's start with a pair of securities, and I'm going to try, this is where the maths comes in, so I'm going to spend a little bit of time talking about that. Right? So we're going to compute the expected return, the variance, and the standard deviation of a stock fund and a bond fund. And what I'm going to point out is there are three states of the world: a recession, normal times, and a boom. In a recession, probability is 20%. Stocks do really badly. You lose 7%. But bonds do well, so you earn 17%. Normal times, most of the time, stocks earn about 12, bonds earn about 7. Boom, 30% of the time, stocks earn 28%, bonds lose 3% of the value. Okay, so this is what you have, and you have to compute the same thing: expected return, standard deviation, or variance. Why? Normal distribution. Those are the only things you need for a normal distribution. Okay, let's do that. So how do you do the expected return? The answer is simple. You just say, what are the different states of the world, and multiply it by the probability. So for example, the expected return to a stock fund is 20% of the time you get -7, 20% times -7, 50% of the time you get 12, 50% times 12, 30% of the time you get 28, 30% times 28, the expected return is 13%. Okay? It's just a weighted probability of those numbers. What about the bond fund? Same thing, 20% chance of getting 17, 50% chance of getting 7, 30% chance of getting -3. That's this equation over here, 6%. Right? So that's the expected return. Okay, what about the variance? Well, for the variance, what you note is you never actually get 13%. Right? Sometimes you get more, sometimes you get less. So what you want is a measure that tells you how far away are you from that 13%. So in a recession, how far away are you from 13%? You're 20% less than 13, -7, -13, 20% below 13, right? Normal times, you're 1% below 13. And in a boom, you're 15% above 13. But if you just add them up, what do you get? First case, you get -20. Second case, you get -1. Third case, you get +15. If you just add them up, the negative number will cancel the positive number, and it'll look like, oh, this is a very safe security. Right? So how do you convert a negative number to a positive number? Simple, square it. Right? So that's what we're going to do here. So what we're going to say is -7, -13, how far away are you from 13%? That's 20% below, square it, 0.04. Same thing. How do you get your 1% below 13%? Square it, you get 0.01. Same thing, 28% -13%, 15%, 0.0225. Right? And once you have those deviations, square deviations, multiply by the probabilities, 20% times 0.04, 50% times 0.01, same thing, which you just did, you get the variance. And of course, take the square root of the variance, you get the standard deviation. You're going back, you're taking out that square, which you just did, right? So this is pretty much high school statistics. Okay. Next, so this is okay, we can do this, right? But what about now putting these things into a portfolio? What's the same thing? The expected return and the standard deviation of a portfolio is half my money in the stock fund and half in the bond fund. How do I do that? Well, one way you can do that is to treat it just like another security. You say, 50% of my money is in the stock fund, so 50% times 7 plus 50% times 17, add them together, I get 5%. Right? So that's it. And they do the same thing, 50% times 12, 50% times 7, that's 9.5, 50% times 28, plus 50% times minus 3, 12.5. And that's a new security, run the whole process all over again. Okay? However, in real life, we don't have those probabilities. So I can't do this because I don't know what the probabilities are for a recession are, what a boom is, what a normal time is. So I have to do something else. I want to go directly from here and here to here. And that's easy. Turns out, if I do it this way, the expected return of portfolio is a weighted average of the amount of money I've invested in each of these. So in this case, 50% of my money is in the stock fund, that's earning me 13% on average. 50% in the bond fund, that's earning me 6% on average. Put the two together, I get my 9.5 straight. I don't have to go through the probabilities. Right? Okay. So expected return is easy. I just weight all the numbers and put it together. All right, but now I want to go to the variance. I've got these two variances. I want to figure out what's the variance of my portfolio. Directly, I don't want to go through all those intermediate steps. So to understand what the variance is, I need a new term called how these assets move together. Because remember, the ice cream company and the umbrella company, they were moving in opposite directions. That's why I could reduce my risk. So I want to figure out, get a measure that tells me whether they go in the same direction or in opposite directions. What do you think over here? Do they go in the same direction or opposite directions? In a recession, one is losing money, the other is making money. Normal times, making money, sort of making money. This is making money, that's losing money. So essentially, they are going in opposite directions, right? So you want to measure that's high when they're going in the same direction and low when they're going in opposite directions. And that's called the covariance of two securities. So this is like covariances over time, and usually this is the case. Stocks and bonds go in opposite directions, except this year, right? So everything crashed at the same time. But, that's bad luck. Okay, so how do we figure out what the covariance is? Well, it turns out it's actually surprisingly easy. So what we have is when security 1, the stock fund, is doing really badly, it's making 20% less than what we expected, the bond fund is doing really well. It's earning 5% more than what you expected. So what you're doing is multiplying minus 20 with 11 to get minus 0.02. So you're multiplying the two deviations together. One's doing well, the other's doing badly. Positive number multiplied by negative number, negative number. Both are doing badly at the same time. Negative number multiplied by negative number, positive number. Right? So basically, if you're just multiplying the deviation, you should get all these answers. Right? So 0.05 in this case is the covariance here. And we call it sigma times SB. By the way, finance involves a lot of Greek. So if you sit through all these lectures, you'll end up with a working knowledge of Greek. We'll talk about alphas, we'll talk about gammas, we'll talk about deltas. So when you go to Greece on a holiday, you'll be able to read the street signs for sure. Okay? All right. What's the relation between the variance and the covariance? We've already done it. If we replace the bond fund with the stock fund, the product of the two deviations is the square of the product. So the variance is a special form of the covariance. The covariance of something with itself is its variance. Okay? So let's leave that. Now we get to a really complicated looking formula. This one says that the variance of a portfolio is a weighted average of the variances of the individual parts plus a product of the two covariances. How do we understand this formula? Let's take an example. Imagine that you have a giant sack with two animals in it, right? An elephant and a mouse. So how much is the sack moving? That's the question you want to answer, right? So how much the sack moves depends on two things. One is how much the elephant moves. That's the standard deviation of the elephant, right? You square it. The elephant is big, so it'll really dominate it. The mouse is relatively small, so regardless of how much the mouse moves, the bag is not going to move very much. Okay? However, it also depends on how they react to each other. Right? Obviously, with the elephant and the mouse, the elephant dominates completely, so you're really not going to see much of a difference. So no problem. Let's say put in two elephants into the bag. Okay? So what you have here, same thing. How much does the sack move? But now it depends on whether the elephant's moving in the same or opposite directions. If they're moving in the same direction, the bag will move. That means high covariance, the bag will move a lot. If they're moving in opposite directions, negative covariance, the bag won't move at all. That's the idea here. Okay? So, putting that into that formula, we're talking about a stock fund and a bond fund, or an elephant and a mouse. Okay? How many combinations can you have? Turns out, you might think, I only have two combinations, elephant or mouse. Actually, there are four. What are the four combinations? Well, the elephant by itself, the mouse with itself. Right? The elephant first and then the mouse. Or the mouse first and then the elephant. They're all four different combinations. Okay? So to put that, what you're going to do is four different boxes. So what you have is, how much is the elephant moving, the elephant by itself? How much is the elephant moving relative to the mouse? How much is the mouse moving relative to the elephant? How much is the mouse moving by itself? Right? So that is essentially our formula here. Kind of looks complicated, but essentially that's all it is. So plugging all these things in, you get a variance, right? Which looks like a complicated thing, but we already got the numbers. That's a covariance. Those are the two variances, and over here are the weights. Okay, fine. So that's the ultimate. When you take all this, what do you conclude? Not really so much about calculating the expected return portfolio. The key is, if you look at that portfolio has a lower risk, lower standard deviation, and a higher return than the bond fund by itself. Right? So, in fact, you can do this for any length of combinations. So, 0% in stocks all the way to 100% in stocks. You just keep running that formula again, and you get a graph that looks like this. The top line there, 100% in stocks. The bottom line point there is 100% in bonds. That's 95% bonds. That's 90% bonds, and so on. So the numbers are, go on this. But looking at that one here, this is 100% bonds, right? That's 7% standard deviation and a really low 6% return. So a question for you is, would you choose to buy a portfolio consisting of 100% bonds? Okay. Right? So again, pretty much of a no-brainer. If you look at this, almost a no-brainer. If you look at this, what you will see is, if you invest 100% in bonds, you end up right there, right? But if you go up straight here if you go straight up from the 100% bonds to 100% stock, for the same risk, you get a higher return. Nobody should pick any of those combinations at the bottom. Forget 100% bond. You should not even go for 95% bond. You shouldn't go for 90% bonds. You shouldn't go for 85% bond, because they're all at the bottom. So essentially, what you have is what we call the efficient frontier. So this is basically saying these are some portfolio combinations which give you the highest return for the minimum amount of risk. Nobody will pick a portfolio that gives you a low return for a high amount of risk. That's pure and simple statistics, right? There's nothing beyond statistics at this stage. Okay, You can generalize this to many securities. I won't go through this, but literally what it's saying is the weighted average of the expected returns of the individual parts, and this is every potential pair of covariances multiplied by each other. And I promised you more Greek symbols, so that is a double summation sign. I'm just adding them all up. Okay? All right. So with 3 securities, what do you get? You get 9 combinations. So 1 with itself, 1 with 2, 1 with 3. 2 with 1, 2 with itself, 2 with 3. 3 with 1, 3 with 2, 3 with itself. Right? So with 4, you get 16 combinations. When I was working at BGI, we had about 3,000 securities in our portfolio. That meant we had to deal with 9 million portfolio combinations. It would take us 2 days to, no, we wouldn't do it. The computer would do it. Right? But it would still take the computer 2 days to do it. Right? But that's it. This is the formula. Right? So it looks really complicated, but literally all you're doing is taking every possible pair and just adding them up. Fine. So the variance of a portfolio is basically a matrix that looks like this. So what you have over here is the stocks. Every diagonal term is a variance, and every off-diagonal term is a covariance. Okay? Let's keep this in the back of our head. And now let's say in a many-security world. So you sort of get the intuition that you put these securities together, you can come up with a portfolio frontier. Right? So we take all these securities, add them together, you have every possible combination of every security in the world. You will end up with a curve connecting to curve connect, all this. And what you see is the outermost convex hull of all these securities is called our efficient frontier. Right? So anything above the minimum variance portfolio is what we call the efficient frontier. Right? So that's why Markowitz stopped. So Markowitz said, okay, you know what? We have so many combinations we worry about that people will hold, but we don't need to worry about most of them. People will only hold efficient portfolios, only portfolios on the frontier. They will not hold any of the internal portfolios because the efficient portfolios dominate them. That's a brilliant conclusion. Also, completely useless. Why? Because there is an infinite number of efficient portfolios, right? Because that curve goes on all the way. So what Markowitz essentially said was, infinite number of portfolio combinations, get rid of the infinite number of inefficient portfolio combinations, and you end up with infinite number of efficient combinations. So that's why he only got half a Nobel Prize. Right? So what did William Sharpe add to this? William Sharpe said, well, there's something you've left out here. And the one thing he had left out was a risk-free asset. Risk-free asset will be there on the y-axis. Right? That is not there. So William Sharpe said, fine, what happens if you put in a risk-free asset? How does it change what we're going to do? It turns out that every combination of a risk-free asset and any other asset lies on a straight line. Why? Because the covariance of anything, how much does the risk-free asset move? It doesn't move. It doesn't depend on the weather. It doesn't depend on the economy. It gives you the same amount. The covariance of anything with a risk-free asset, 0. Variance of the risk-free asset, 0. So every combination of anything with a risk-free asset will lie on a straight line. Right? If you have half your money in the risk-free asset, half money in the risky is halfway there, and so on and so forth. Fine. So what he then said was, all right, let's draw a tangent line between any of the intermediate points to the efficient frontier. Now, if you don't like risk at all, you can invest all your money in RF. If you like a moderate amount of risk, you can invest on the white line. The white line is always above every efficient portfolio on the curve. So what he's basically saying is, a white line is a combination of RF and a balanced fund, which is a tangency portfolio to that curve. Right? That's all we need. So he says, everybody in the world should invest only in 2 assets, a risk-free asset and a broad-based market fund, which covers every security in the world if you can get it. If you can't get it, take as broad-based an index as possible. So the S&P 500 index or the MSCI Global Index, take as broad-based an index as possible. That's the efficient way to proceed. Okay? But that means we can now derive an equation. Now this goes back to high school trigonometry. And the equation of a line is very straightforward. Y, the number on the y-axis, is equal to the intercept plus slope times x-axis. Everybody presumably remembers that from high school. Okay? Fine. We'll drop that, that's sigma m. That's the expected return on m. That's RF. and that's the distance, the perpendicular and the base. So the slope of a line, perpendicular divided by the base, right? So what do we have? The expected return to a portfolio, number on the y-axis, is the risk-free rate, the intercept, plus the perpendicular, Rm minus Rf, divided by the base, sigma m, times the standard deviation of the portfolio. That is a version of the CAPM. What that tells you is, if you give me the standard deviation of the portfolio, I can plug it in here and tell you what the expected return of the portfolio is. How useful is this equation? Totally useless. Why? Well, it's because we already know that all these lines lie on a straight line. We don't need all those calculations to figure out what is the equation of that line. We already had it from history. What we want is the individual assets. How do the individual assets, what's the formula for that? And this formula doesn't work for that. So how do we go from a portfolio to an individual asset? To understand that, let's go back to this one here. Right? I've now established that everybody in the whole world is holding the risk-free asset and the market portfolio, M, the balanced portfolio, right? The global portfolio. That means if I say, invest in my company, that person is going to say, okay, how much does my risk go up if I add you to what I'm already holding? But what am I holding? The market portfolio. So the measure of risk is relative to what I'm already holding, the market portfolio, okay? But going back to this line here, if I add one new asset to my portfolio over there, I'm adding only one variance term, the diagonal. But I'm adding two n here and n there, covariance terms. Which is more important, the covariance or the variance? Obviously, 2n covariances, only one variance term. The covariance is way more important than the variance. Put that into another way of thinking about it is you have a bag full of animals. Right? They're all in the bag. You stick a tiger into the bag. The movement of the tiger isn't as important as the movement of all the other animals reacting to the tiger. Right? That's why we say the covariance is how the other animals in the bag react to the introduction of the tiger. But the tiger itself moves a little bit, not going to really affect how much the bag moves. It may affect it a little bit, but it's really not very much. Okay? So the idea, therefore, is if everybody is holding the market portfolio, what we want is the covariance with the market. That means how much does the market move if you add your security to that market? How close are you to that market? Okay? That is called the beta, another Greek letter. Okay? So what is the beta? Well, that's the covariance. But the covariance changes depending on how much the market's moving. If the market's moving a lot, the covariance will be high, purely artificially. Nothing to do with the stock. The covariance is high. So you need to standardize it by dividing it by the variance in the market to control for points in time when the variance is high and the covariance, or when the variance is low, right? You're controlling for all of that. So we also know if everyone is holding the market portfolio, the beta of the risk-free asset must be 0. Why? Because the covariance of anything with a risk-free asset is 0. We also know the beta of the market must be 1. Why? Because the covariance of the market with itself is its variance. Variance divided by variance is 1. So, putting that into context, this is the final equation we're going to look at. What this says is the risk-free asset has a beta of 0. The market has a beta of 1. So, what is the equation of this line? Well, again, the same thing. Y is intercept plus slope times x. The intercept, the slope is perpendicular divided by base, Rm minus Rf divided by 1. The intercept is just Rf. So that's the formula. Right? Expected return is Rf plus beta times Rm minus Rf. Right? That number, that equation, is called the capital asset pricing model. What that basically says is, if you can compute the beta, which is the covariance of anything with the market, that tells you how risky that asset is. Okay? In this particular case, expected return is Rf plus beta times Rm minus Rf. Right? That formula got William Sharpe his half of the Nobel Prize. Right? So 2 parts. One part getting to the fact that only people would hold efficient portfolios. The other one going one step beyond, introducing a risk-free asset, which would give you this formula here. So everybody okay with this, with risk? Sort of. Okay, let's see if you really understood this. Let's say we have two companies, SolarMed in Madagascar, where the environment, lots of degradation, deforestation, overgrazing, and so on, lots of major infectious diseases, high food insecurity, and it has repeated bouts of political instability, including coups, violent unrest, and disputed elections. That's Madagascar. Okay? The other side, Tesco in the UK, well, the UK has a whole bunch of environmental problems. Right? We have health, we have obesity issues, Ozempic, all these things. We also have high inflation, right? And we have high political uncertainty, right? So all these things together, the question is, right, which one is riskier, okay? So that's what we want to establish, right? Which should have a higher discount rate. So what we have is the Madagascar central bank rate is 8.9. The Bank of England bank rate is 5.25. GDP growth rate 4.4. This is about 0.2. Inflation rate 9.31. Inflation rate 6.5. And the Madagascar market is about 4 times as volatile as the UK market. So for you guys, final question, what do you think should be the risk-free rates? The discount rates. So if you think Tesco is low risk, that should be here. If you think SolarMed is low risk, it should be there. If you think SolarMed is high risk, it should be here, and so on. So just drag your pointer on your phone. Brilliant, right? And this is common sense, right? SolarMed is riskier than Tesco. Also, completely wrong, right? Why? Well, think about what the CAPM is telling you. It says, how much risk do you take on when you add SolarMed or Tesco to what you're already holding? But we're here in the UK. What are we holding? The UK stock market. So, if something happens in Madagascar, yes, SolarMed is incredibly risky, but it's a small part of our portfolio. Madagascar is uncorrelated with the rest of our portfolio. The risk doesn't matter. Tesco is a big part of the UK market. If something happens to Tesco, our entire portfolio is affected because we're already holding the UK market. If you're a global investor, the UK is the bigger part of the world than Madagascar is. Right? The key part is, what are you holding? If you're holding a big global diversified index, which you should be, Tesco is way riskier than SolarMed. Okay? That's the takeaway which we have over here. That's the counterintuitive part. We don't care about risk, which is unique to Madagascar. That's risk you can diversify away from. You can just buy as many securities as you can, and you don't care about Madagascar. It's a tiny part of your portfolio. But some stuff you cannot get away from. Even if you hold every stock in the world, the price of oil will affect you. War, geopolitical risk will affect you. Climate change will affect you. How much it affects you depends on the beta. And that's what the CAPM says. The higher the beta, the higher the level of risk, and therefore, the more returns you ask for. Okay? And that's it.
Thank you very much, Professor Rau. That was great. I've got a few questions on here, then I'm going to come to the audience in the room. So the first question is, how do we account for the fact the correlations we input into the model are only historically relevant? We don't know how they're going to work as forecasts.
Good question. Yes, the numbers are all historical numbers. And ideally, we would like forward-looking numbers. But with all due respect, if you know the forward correlations, you should not be here in this lecture. You should have your own private island somewhere in the Caribbean, maybe not island anymore because of climate change, but whatever, right? You should have your own lair. So the best we can do, indeed, is to look at historical stuff, but look at it for a very long period of time. So for example, when we compute things like the risk premium, we go back all the way to 1925. Why? Because we have that data. And why do we need to go so far back? Well, think of 1925. We've had the Great Depression, we have had world wars, we've had multiple local conflicts, we've had disease outbreaks, we've had literally everything. So the number is going to be there something. History repeats itself. So the idea is long periods of history should indeed work for future. We hope, right? But of course,
we hope.
I can't guarantee anything.
We hope. And also we have to bear in mind that they don't affect the individual stocks. We have to be careful we don't put a whole theory onto buying one stock. Because basically people are gamblers. They're optimists. That's why more people wanted ice cream than umbrellas.
Excellent. Actually, that is an interesting point. I'm going to build on that a little bit. One of the things which a lot of people say is, I'm not diversified myself, right? I'm only holding Tesco. I'm not really holding the entire market. Why does this risk? Why am I not thinking SolarMad is very risky compared to Tesco? The answer is, if you're not diversified, you're taking on a lot of risk. That means you're not willing to pay so much per share. Who is the person who pays a lot per share? The guy who's diversified, because the risk doesn't matter that much to that person. A big mutual fund, a big pension fund, they're highly diversified. So they set the price. If you're not diversified, you're not in the market. You're not willing to pay high enough a price to get there. So it doesn't matter. So the people who are setting the prices are indeed the diversified investors. That's why all this works. Okay?
Thank you. And now, anyone here would like to ask a question? The gentleman down here, just wait one moment for the microphone.
Going back to the very early part of your talk, you didn't build in several factors. One, the inflation rate going at the current time in any market, which actually influences the way trading happens in markets, which then impacts on the rate you get on various investments. And the other thing you didn't actually, on the umbrella and ice cream model, you didn't allow us to have shares in ice cream for the 6 months in the warmer period and 6 months for umbrellas in the winter period, which is where you make the profit.
That's a very good point. The second point in particular, you can switch back and forth between, in the different parts of the year, warmer months, cooler months, fine, right? But that doesn't affect the basic model. Even if you do that, allow that, you can actually still run through exactly the same calculations to get the idea that you're diversifying, right? And again, think climate change, right? Are you really going to have warm winters or warm summers here? We don't know. Could be, but we can't predict the future, right? Your other question was about things like inflation and other factors, expectations built in. We're assuming they're built into the rates which people are asking for. So they take that into account when deciding, number one, how much should government bonds to buy, right? Because they have to worry about inflation. How much will the bond actually buy me? So those are expectations that are built into the numbers already.
Lovely. Thank you. It's past, one more question, and then that's the last one because we are past 7 o'clock. Sorry, I just realized.
Thanks for a great talk. It seems like the covariance between one stock to all the other stocks in your portfolio is very important. How do you exactly calculate that? It seems like you assume that you need to have the expected, the performance in 3 different categories, like normal time, recession, and
right.
Good time.
Okay, so the background to everything we did was to assume that we knew different states of the world and we assumed the probabilities. But later on, once we know what the returns are, right, based on historical factors, goes back a little bit to what Lucy was talking about, we kind of say, okay, over the past 100 years, that's the expected return for the stock. We're using historical data. But once you have the returns to each individual security, you don't need the probabilities anymore. You assume that built into the numbers.
So it doesn't apply to new stocks that you don't have that historical.
True, but then think of the fact here that these are market participants who are taking this into account. If you think a recession is now much higher probability than before, do you buy stocks or bonds? You buy bonds because you know that stocks are going to do badly in a recession, right? So the numbers, the prices will adjust based on people's estimates of the true probability. Okay. These are assumptions, and we'll see in the last lecture in June next year that people sometimes go crazy and the markets behave in very weird ways. Right? But that's a subject for next year. Okay?
On that note, can you please join me in thanking Professor Rau very much?
Thank you.